So I think, as investors, you have to be always forward looking, right? And so you have to visualize the world, sort of 12, 24 months, down the road. Obviously, if you look back in the last year and a half, as you pointed out, the financials took the brunt of what happened as the, borrowers' earnings capacity got impacted, their repayments got impacted, the growth was not there, the asset quality was affected. So for a whole host of reasons, financials have taken it on the chin, and that's what is getting reflected in the market. But if you look forward that 12 to 24 months to an environment where, COVID is, hopefully behind us, in that environment, these companies, the growth can resume. I think as it is, you're seeing with inflation coming back, the demand for credit is increasing. And as the demand increases, you would see the top line of the companies continue to increase. There is a sense around the world that the central banks are being very cautious in terms of increasing interest rates. And so as a result, the cost of funds should continue to lag the demand or interest rates in the market. So the spreads can remain healthy. But the biggest hit that companies have taken, financial companies, was in terms of the provisions they have to take, right? And that provision in a post-COVID world, or in a world where people have sort of learned to live with COVID, should not be there, right? That's a one-time impact. And so profitability of many of these financial companies can improve quite substantially. And so that's, the sort of case, the rational case that you can make for investing in financial companies that have been beaten down. But even more interesting than that is that their companies, they mentioned about the mid-sized companies that are differentiated. And if I may take an example from our portfolio, is a company called as Aptus. Aptus Value.
Yes, please do.
Yeah, so Aptus Value Housing Finance. And again, this time, we've owned this company for the last several years. But this is a company that in FY21, I mean, think about FY21, it's probably the worst year that I can think about for financials in the last many, many years that I've seen. In that environment, Aptus was able to grow its earnings by 40% year on year. That's a phenomenal performance in the face of a very, very tough environment. And, if you look at their financial numbers, if you look at their ROAs is north of 7%, very limited leverage, this company can grow its earnings by 25% compounded for the next many years, right? They got listed in, about a quarter ago in an environment where, there was a lot of sort of public listing. There's maybe an IPO fatigue to some extent. And because there's a general, pressure on financial, it hasn't done much. But if you look at the fundamentals, like the only two companies in India that I can think of, financial companies that have had fundamentals comparable to this, is Gru Finance and Bajaj Finance in the past, right? And you've seen sort of how those companies have created value for their shareholders. And we think that Aptus has the ability to do something like that. And because there's a overhang on financials, it's not getting reflected in the price. But as they keep delivering their numbers, if nothing else, at least you can see a 25%, sort of appreciation in their earnings that should get reflected in price.